Good day, fellow investors. The Magnificent Seven are a bit down over the past few months, and in a recent poll that I make, we had 2,500 votes, and most of you asked for a deep dive into the risk and reward of the Magnificent Seven. Which is exactly what we are going to do. Calculate the intrinsic value, understand the margin of safety, look at the long-term likely investing outlook so that you can put that clear risk and reward value investing perspective into your comparative table framework, and then see how it fits your portfolio at current levels. And I'll also tell you in which one I would invest if I had to invest $1 million into just one stock. Let's immediately start and then finish also with a comparative analysis, including our value investing quadrant and intrinsic value comparative table. Let's immediately start with Apple. If you look at Apple, the key factors there: market capitalization 3.3 trillion, P ratio 34, dividend yield less than 0.5%. Okay, you see 10% down year to date, but when I look at the longer term chart, Apple is still a 6x over the last few years. Thus, this trend is something hard to keep, and therefore we have to look at the long-term sustainability of current stock market returns. If we look at the company, the current revenue, 4% revenue year over year, a little bit better on earnings, 10% year over year. However, if we look at the key data, the iPhone still makes 55% of sales. iPhone sales are actually down, and other things are the key drivers, and key is services. But services are always again connected to iPhone users and iPhone sales. Therefore, also if this goes down more significantly, then this can go down equally. Further, Apple is reinvesting all the money into buybacks. Everything that they make is reinvested in buybacks, a little bit into capex, but not that significant. As you can see here, cash from operations 108 billion, repurchases 104, and also dividends. So everything is focused on that stock price. And in summary, if you look at Apple, you have 100 billion net income returns to shareholders compared to the market capitalization of 3.3 trillion. That's 3% return from the business. Then we can assume growth, and that when you come to a P ratio above 30, everything is about future growth. And small changes in growth also hugely impact the valuation. And if I look at Apple over the last few years, it is not a growth story. Now, there can be promises of future growth, but there are also risks. Declining iPhones. The last 2 years have also been great from an economic perspective, which led to higher iPhone, smartphone purchases, companies growing, developing, etc. However, if we have a severe recession, a real recession, iPhone sales could also drop significantly. Not to mention competition, China manufacturing, regulation impacting the company. And perhaps this is something that few look into going forward and valuing Apple, because consumer spending in the US has been very strong over the last few years. And if this changes, iPhones and things like that might be sold less. Also, if you look at the last time we have had a severe recession, or this we cannot count a recession, the pandemic downturn, which lasted 3 months. So we haven't had a proper recession for 16 years now. That is something very specific, because you can see how recessions usually come much more thicker. If we have a real recession, that would also impact Apple, the growth, but that is something we have to consider when it comes to a margin of safety. Let's calculate the intrinsic value. If we go to our free downloadable template, you can download this in the link in the description below. Also check the video explaining it. We have here Apple, you click here, And you have immediately the template, 3 scenarios, dividend payout ratio, I have it at 16%, that's something like that, 15 billion on 100 billion net income. And earnings per share, 6.28 for the last year. And now, the key is here, the growth rate. I always expect a 10% return from my investments. Terminal multiple, let's say that the P ratio normalizes to 20. Keep in mind, we are making a 10-year long calculation, therefore valuation normalization is something to be expected. If I put all the numbers here with 7% earnings per share growth going forward, the intrinsic value for Apple is $97, which is pretty low compared to the stock price. Of course, if I go more exuberant, 14, 12% growth rate, 30% terminal multiple, then, only then, would Apple be justified from a current perspective giving you a 10% return, because yes, then the stock would be at 570 10 years down the road plus the dividends, and you have a 10% return. However, this is a little bit too exuberant. Let's say 8% and then 6% and discount rate 25. We have to take some long-term averages here. And then again, even in the positive scenario, the present value is 121, far away from the current level. Worst case scenario, let's say that Apple doesn't grow at all over the next decade, that the P ratio becomes 12 down the road, then the present value is 35. That's 80% down from where it is now. Let's say normal case scenario probability 70%, best case 15, worst case 15, and we are there around 90, 100 when it comes to the valuation of Apple. That could be a 4 or 5% return going forward, but if you want higher returns, then you should buy it much lower, much cheaper. Therefore, Apple is here a pretty expensive stock to buy. So I don't think the valuation will hold into eternity. It is too high, especially we later compare things to the 10-year treasury. The ecosystem is, yes, strong. I'm using Apple to film this, to do everything. So the connection with the customer is there, but there is always this hope, Apple Intelligence, things like that, that there will be growth coming from somewhere, but we are not yet seeing significant impact growth on the company, at least we haven't seen over the last few years. Therefore, it's priced now for perfection, not including a recession risk, and if for any kind of situation buybacks go down, so does the stock, and therefore also index investing flows are pushing the stock higher. Therefore, it's extremely expensive. It is the most expensive company in the world. And I think that the likely long-term returns over the next decade will be 0, and that is on the 80th percentile of possible returns. There is a 20% chance that returns will be higher than 0, and an 80% chance that returns also be lower than 0 from the current perspective. Therefore, on the value investing quadrant, I would put Apple on very high risk, very low reward. That is the situation that is represented now. If I look at earnings per share estimates, growth expected going forward around 10%, and you see here, that is with all else equal, all things going well, but if there are any issues, if we look at the margin of safety situation, and then you might say, Sven, you're crazy. No, I'm not crazy. I did buy Apple here in 2016 when the P ratio was 9 compared to the 35 now. Also, no margin of safety from a value investing perspective. By the way, if you look for increasing the value investment exposure in your portfolio, you might want to check my research platform where we cover potential and current value investments, interesting off the beaten path ideas. There are also free portfolios. I'm buying something each month, and therefore you can see how this value investing perspective might fit your long-term investment goals. The next one, Nvidia, 20% down lately, but again, as Apple has really boomed recently. And we have discussed 4 months ago how 6 of 7 factors tell Nvidia stock is in a bubble. Now we are a few factors lower as the exuberance has gone a little bit, but here you can see the long-term return. It is still a 10x over the last few years. A 10x on the AI, the new industrial revolution, agents, factory scaling, training, physical AI for robotics, everything is booming. And we can also see at Nvidia's revenue from a little bit boomed to, what is this, 25% of the market, and the expectation is for fast growth. And if all else equal, this doubles, we might also see Nvidia's revenue and profits double or even more over the next few years. They are constantly ahead of the competition, therefore they can charge more. They are driving significant returns into the cycle and also staggering growth from almost no cash flows to 60 billion in free cash flows. And if that continues, then we could expect 120 billion in free cash flows. If they also go away or grow on other gaming, professional visualization, automotive, like they did into the data center situation, then this could really boom. For now, there is a pause, so just 2%. They only give 1 quarter guidance. However, if we look at estimates, they expect 50% growth over the next year, then 27%, 15% going forward. And if I look at this, if Nvidia hits this, then it will become cheap, all else equal. Because if they grow, if they double from the current 60 billion to 120 billion, and they keep on growing in the future, then the P ratio of 40 now becomes a 20, and 20 is simply too cheap for such a high growth company. Plus, all the hyperscalers have announced huge investments into AI, which should benefit Nvidia. Just to show you here the bigger picture, investments into tech, AI, cloud growth expected to be 254 billion into 26. And if we look now at whether Nvidia is still in a bubble, we have price to free cash flow of 48, but if the growth continues, that can be 24 or even lower in the future. But yes, we are extrapolating future growth not into eternity, but at least 3 years for this to be there significantly. Now, naive buyers, everyone was attracted to the stock going up. Now we are 20% down, so that is the time to look again at what's going on. The bullish sentiment is now fighting, not that much there, and also forward speculative purchases are there on AI because we don't yet know, and something that we'll also discuss in the video, the return on investment on AI. And let's calculate the intrinsic value for Nvidia. I have put here free cash flow in billions so that we in this case compare it to the market capitalization. 60 billion free cash flows, they are all spending the free cash flow into buybacks, at least that is their goal, as the dividend payout ratio is just 1%. That's unlikely that the dividend will be significant. If they grow at 15%, 10%, terminal multiple normalizes to 20, then it is still a positive return then going forward, but too expensive from that current perspective. If they grow 25% for the next 5 years per year, 10% then, terminal multiple 25, then it is priced for a 10% return, as the market cap would go from the current 3 to 6.7 trillion in 10 years. However, if things go south, and let's say that there is competition, there is this, there is that, and that they boom and then they go down again, and that they don't grow in the next 5 years because there is the AI cycle or things don't work as expected, terminal multiple 15, and then we have a company worth 400 billion, far from the current situation. This would be a margin of safety situation. And if I put this into the comparative table, you can see here that Nvidia will likely deliver 4 or 5% return over the long term, but not much more if it can't surprise. However, of all the companies that we are discussing here, and what we have seen over the last 2 years with a huge boom in revenues, market share and everything, it might be the case that Nvidia is the company that can surprise from all of this. Of course, you never know. There is competition from China. Everyone is also developing their own semis. The question is always, what will be the long-term profitability of this AI environment? There is always the semiconductor industry cyclicality. If AI profitability doesn't hit in 2026, 2027, but 2029, 2030, everything changes because investments go down, supply goes up, nobody makes money, and that's standard for the semis cycle, for the semis industry cyclicality, and then you have a return to a margin of safety. Maybe these guys will cut investments to have in 2026, that's a year from now, that's huge when it comes to long-term investing. Then again, everyone is projecting here 50, 100% growth over the next few years. That is possible. However, due to that potential of continuous expansion, I would say that Nvidia is, let's say, still risky, but will likely lead to a better return than when it comes to Apple. On the margin of safety, you're calling me crazy, but this was 90% lower just 3 years ago, or 2.5. So that is the margin of safety. You have seen the destruction when the industry and the cycle reverts. Nobody makes any money, not even Nvidia, and that is the huge uncertainty there. Next one, Microsoft, 16% down recently, but if you look over the last few years, it is a 2x, so it just continues doing what they are doing. They have this 12% revenue growth, net income 10% growth, and if I look at the numbers, they have boomed on that net income over the last few years, done really well. They have now increased their capital expenditure in order to cater to AI. Keep in mind, they were spending 15 billion per year a few years ago. Now they go into 55 and everyone is spending, and they have also lowered buybacks in order to spend more on capex, and there is the 23 billion dividend. Something very important also to comment here is the cash acquisitions, 70 billion, where they acquired Activision, and they will likely be searching for growth more in the future, which is another factor that we can discuss. And if you look at the research from Fama and French, where they developed the three-factor model, they always found that size impacts growth and returns over the long term. Small cap stocks historically outperform large cap stocks. That is the situation, which makes it hard for these companies to find more growth. Or if they can find growth, the key question is at what cost? Is the return on investment justifying the growth? Let's calculate the intrinsic value. Microsoft here, I have used earnings per share 12%. If they keep on growing at 8%, 10%, terminal multiple 20, the intrinsic value is 280, which is a little bit more than half of the current price. If they grow at 10%, terminal multiple 25, then we are closer, but still not close for a 10% return. Margin of safety, if there is slower growth, terminal multiple goes down, we are down 60-70%. Some 220 compared to the current stock price, again priced in line with everyone else, 5% likely return, all else equal and excluding shocks. And also when it comes to valuation, we have to look at the 10-year treasury that gives you a guaranteed 4.2%. If we look at P ratios of 30, 40, this is 3, even less, 2.5, 2.3% earnings yield. Thus, these companies need to deliver a lot of growth. And therefore, this will determine the valuation long term. If interest rates go down, then okay, these valuations could be justified. But if we have higher interest rates, perhaps stagflation or things like that, then the valuations are not justified. And I have to put here the companies, especially if there is a recession, less spending, on a high risk, low reward framework. A little bit looks better than Apple, more market certainty, long-term business, but still risky there. Now, Amazon, when it comes to Amazon, also down in line with others, 18%, market cap 2 trillion, P ratio 35, but Amazon has also done okay, not stellar over the last few years. However, sales are still growing and operating income has been more the focus over the last 2 years and therefore has exploded, 86% up, net income 95% up. However, free cash flows, as the investments are huge, are up just 4% at 38 billion. If we look at where the money is going, they have spent 77 billion over the last year, and they are likely to spend 100 billion next year. If we look at what the CEO has been saying, also for AWS, the growth will be lumpy over the next few years, and that is also the lumpiness that you have to expect into the stock prices and valuations. And given the valuations, you can expect high volatility. Capacity consideration, timing, it's hard to overstate how optimistic they are, but keep in mind that it might take a few years and they are thinking several years out. And of course, built on top of the cloud, and they are investing into that. But also something to keep in mind when it comes to the whole business, this is AI. Silicon, they are developing their own, thus everyone is also doing that and increasing the competition with others. They are investing 100 billion likely next year and then going also forward. If we look at these huge 100 billion investments, they are almost eating all the cash from operations. You can see here the capex for the last 12 months, 83 billion, and it will likely grow going forward. The question is, as always, what is the AI ROI? And we will see whether these hundreds of billions spent will lead to hundreds of billions of dividends over time, or they will just spend, which will lower prices and be a huge benefit to consumers, but not maybe to them. We will see that. If we go to make the intrinsic value calculation, Amazon net income 80 billion, market cap 2.1 trillion. Now, why is my net income a little bit higher than theirs? Because I'm looking at their investments and their potential net income. They are making 110, 120 billion. They don't have to spend 80 billion to keep the business going. They can spend also 40. And therefore, I'm calculating here the potential net income. If they decide to spend later, if they build the capacity, that is Amazon. And therefore, it's a company that I like very much out of the Magnificent Seven. And if they grow at just 8% terminal multiple, then okay, we are at 1.2 trillion, far from the current valuation, but okay. 12% terminal multiple 25, then we are fairly priced, but in a low case scenario, we would go down to 700, 800 billion. And you can call me crazy about that valuation, but just again, 2 years, 3 years ago, Amazon was trading almost below 1 trillion, and we discussed that in a video how the risk and reward is extremely positive. And that is what is value investing and what we are looking for, and why I'm doing these analyses to follow them, put them on the intrinsic table, and then when the time is right, also consider this for a value portfolio. Another issue with Amazon is the efficiently managing dilution situation, because they have again diluted 100 million shares over the last year. 100 million price, that's 20 billion, and that is something that is to be considered. And when it comes to Amazon, I have put it here on the table because when you look at what is already there, the e-commerce site, the others are not going to easily take that from Amazon as a competition. There is always risk, but the likely return that we have also seen on the table is 6-7% possible, and therefore something also to consider now. From these businesses, I do really like Amazon as a business, as what they are investing in, and how they are building their ecosystem, and therefore I would say one of the most interesting here, but we'll compare all of them later. The next one, Facebook, Meta platforms. Now, this is something crazy. 600, I see the stock price reached past 700 just recently, and I remember also buying it here on YouTube just when it was trading below 100, when I said it was too cheap. And you can see here minus 70%, it was down. That is crazy, and that decline made also Meta a better and better buy. And this is exactly what we have to keep in mind when it comes to investing. You invest your money for long-term goals, 10, 20 years. However, all the analyses I look at are shortened into this year, this situation. Analysts always just look ahead 4 quarters, 8 quarters. It is very hard to look in the long term, but we have to look it from a long-term risk and reward perspective. And if we look at the numbers have boomed over the last 2 years. That is why also the stock boomed. Costs didn't go as fast up as revenues. Therefore, earnings boomed, and capital expenditures also are now increasing a little bit, as also Facebook is investing, Meta, is investing in AI. However, one of the reasons for the growth was a focus on profitability, where they are hugely increased the number of ads in your feed. Now that has lowered, but they are still increasing the number of ads in the feed. They are pushing it for that profitability. Plus, as things in the economy we have discussed have been well, and we see also increase in prices fighting for those ads. This has exploded net income from 20 billion and stagnating to 60 billion. There is significant stock-based compensation. CapEx is also going higher, and their focus is now also on repurchases. That also pushes the stock higher. If we look at what Mark is saying, they are focused on this AI assistant. A few years ago it was virtual reality, and then they switched, and now nobody's mentioning virtual reality anymore. Zuck is also saying how he has now the administration in his pocket, and that leads to optimistic things long term. Then I have AI, glasses, massive infrastructure projects, accelerate business in the future of human connection. They're also building their own custom silicon like everyone else. The risks, competition, regulation, politics can change in 4 years, and then a lot can be undone. Investments, the return on investment on building their own silicon and things like that. And then, of course, a recession or simply changing customer preferences where you don't want to look at triple in ads on your feed. If we go to the comparative table, Meta, here we see that earnings per share 24, and then if they grow at 8%, still overvalued or fairly valued in this market. They're focused on buybacks, higher growth rate, higher terminal multiple. We are close to the stock price, but if there is a bad situation like we have seen just a few years ago, you see here the margin of safety, which would make this a very interesting situation if all else is equal with the business. However, from the current perspective, expect 4-5% returns, maybe a little bit higher, depending on recession situation, things like that. That is Facebook. When it comes to it, I have put it here because there are significant risks. You don't ever know how things will develop, and we have seen how ugly it can get already. Next one, Google, also down 20% and still doing well over the last few years, but you can see a more normal trajectory there, and the key is, of course, the very low price to earnings ratio there compared to the other players. If we look at the numbers, 14-15% growth, so really good. Earnings grew even faster, and they are now at 100 billion net income. There is also 22% of that is stock-based compensation. Huge capex going to 52 billion, but they are also going for AI-powered cloud solutions like everyone else, their own GPUs, TPUs, whatever. So as everyone else focused on AI, here there is also discussion on the competition, but they think their models will do best when it comes to investing, and then everything will accelerate, scale, and that is good. If we go to the valuation, of course, Google is cheap, and therefore here, if they keep on growing at 8%, P ratio 20, 131 is not far from the current stock price from a conservative value investing perspective. And if they grow a little bit faster with a higher terminal multiple, we are there for a 10% return. Therefore, Google looks fairly valued at the current situation, especially from a relative perspective going compared to the others. However, if they grow just at 4%, lower terminal multiple, then there is some room for downside. But still, comparing the current price, this looks like a good 6-7%, 8% return from Google from that intrinsic value situation. And therefore I would put it here with Amazon, perhaps maybe a little bit less risk, but let's say equal to Amazon here. Of course, the risk is that the search goes away because now everyone is investing into an AI assistant that can switch you away from that search, which is a risk that we have to look and see how it develops going forward. But as long as you watch me on YouTube, smash that like button. Tesla is down a little bit more than the others, but still up when you compare before the election boom. Now there is the after election bust. However, still the best return there also with Nvidia over the last few years. If we look at the situation, now there is always this issue that I have with Tesla. Everything is always made on promises. From full self-drive to robotaxis leading to profitability. But if we look at the current situation, we see now the first decline in automotive sales, revenues flat, net income down significantly, and you then ask yourself a question, okay, it is always about future promises. Of course, a few years ago, this was huge profitability promise. Now we have Cybercab, something else leading to profitability. I cannot even value Tesla because when you look at the investments and the money made, and if you move away the tax credits, it's not any. So Tesla hasn't made any money in the last 10 years. Therefore, I cannot even value it. If I take the earnings per share, and I think it will not grow because the focus is not on making money and the competition will be high in the future, then my intrinsic value of Tesla is 20 per share. So that is what it is. And yes, if you go to ARK Invest, where I was getting a little bit dizzy about their big ideas, but look at this again. So only Tesla has autonomous commercial launch, but all these guys, this was the same situation with electric vehicles. All the other guys were saying, okay, let's wait, let's see Tesla break the ice, and now you can buy an electric vehicle from everyone. They are just looking at different expectations at when things will reach profitability and investment. But again, it is likely there will be a lot of competition when things really hit the right spot. And ARK estimates a 10 trillion market for robotaxis. That is 12% of global GDP, even higher, which is crazy. And if you look at Tesla, production is down, okay, production Model 3 is going up. However, if we look at other projections, it's not trillions. In 20 years, the market could be 174 billion. That's billion. And then you compare to the market cap of Tesla, and it isn't much money. Also, Goldman Sachs, 10% of new sales going into 2030. Also, S&P Global. So switching to more practical solutions. So we do not know where and when will level 5 autonomy hit. What will be the sales if you look at this? Maybe it will be a little bit more, but there is time also for others to develop, and the leader for now is China. So I don't think that Elon Musk will ever make you $1. Crazy risks, huge competition, and there is this also factor of timing. When it becomes yes, then everyone else will go into, and you simply cannot have a long-term durable competitive advantage. Maybe Tesla will be the first mover, but then others will simply eat up the pie, which is what's going on also in the electric vehicles. Tesla, it's not a sustainable business model for me, and I will not even put it on the value investing quadrant. Now, let's make the comparison and let's start by size. This is the 2000 S&P 500 list, only Microsoft is there. All the other companies in the Magnificent Seven here are new. Thus, as those were the companies in the past, we can also expect that many new entrants will go after these companies. We cannot know what will the world look like, especially given technology, how fast it's going, in 15 years. 1990s, the leader there was IBM, and now you cannot even see it. Plus, everyone is talking about AI, because once there was a clear separation. I did phones, I did social media, I did search, e-commerce, cars, chips, and office. Now, there is no separation anymore. Everyone is going to do AI. Plus, they are all investing into the AI infrastructure, but they were all companies that benefited from the internet infrastructure. We don't know which companies will benefit from the AI infrastructure. Value investing is about certainty, higher degrees of certainty, with less risk, without incurring huge risks. And therefore, this Magnificent Seven, although interesting, is not something that I would go into that fast. But if I had $1 million and I had put it into just one stock, that would most likely now be Amazon, because of the e-commerce that will continue working likely and all the infrastructure that they have built, where I see more a moat compared to others. And then they can invest the money going forward, and if they have to invest more, they do it. If not, they do less, and they have high profitability compared to the market capitalization. So that's my investment, but still very risky given all the AI investing that's going on with all the competitors. For more value investing, subscribe, check my research platform, and I'll see you in the next video.